What is going on, guys? I hope you are all doing well and the day is finally here. The day that I teach you guys this 5-minute strategy that I've been talking about for years on end without actually teaching you guys the real breakdown on how to apply this concept. This concept was only ever really taught to my students, and if you guys don't already know, in January 2025, I no longer run a course or I no longer lead an academy. From now on, I will be teaching and educating you guys for absolutely free on this YouTube channel alone. I will be sharing with you guys all the concepts, all the strategies that I apply that has made me over $500,000 in just this year alone. So make sure you like, comment and subscribe, because this channel is about to be the only channel that you need to become a consistently profitable trader. So stay tuned, because now I'm about to break down how to apply this 5-minute concept. And guys, just to keep you aware, this 5-minute concept cannot be traded alone. I apply it with supply and demand, the understanding of premium and discount, inefficiencies and liquidity concepts. All of this application with the use of this 5-minute concept that I'm about to teach you guys gives you guys a complete edge and a complete strategy that you can finally trade, and it is proven to be consistent and profitable. So now, get your pen out, get your paper, and make sure you take down notes with what I'm about to share with you guys, because this concept alone will elevate your win rate and allow you to become the trader that you're destined to be. And finally, the lesson that you guys have all been waiting for, the 5-minute strategy that I keep talking about in almost every single live call that I have been hosting with you guys. Let's get right into this lesson. So the two terminologies I want you guys to familiarize yourselves with is DR and IDR. DR simply stands for defining range. IDR simply stands for the internal defining range. Okay, once you're familiar with these two terminologies, let's move on to the importance of these ranges and the time that these ranges are created in. Now, for the London session DR range, so the defining range, it occurs during the 3 to 4 a.m. window. Okay, this is the first hour of the London session open. We have to mark out this range. Rather than doing it manually, you can do it using an indicator. So if I show you guys now, just search DR/IDR on the indicators using TradingView, and this is the settings you need. The most important thing is the RDR time, 9:30 to 10:30, and the ODR time, which is 3 to 4 a.m. So just make sure that is correct. You can tick the after one off because we don't trade the Asian session DR. You can remove the opening line, and you can get rid of the show standard deviation line. Okay, let's get into it. But beforehand, just remember, guys, these are the two timeframes you need to be familiar with. So the London session's defining range forms during 3 to 4 a.m. and the New York session defining range forms during 9:30 to 10:30 a.m. This is all for the New York time, okay? So let's get right into the chart, and I'll show you guys the difference between the defining range and the internal defining range. So right now, we are looking at the New York's defining range on the DXY, and this is today's price action, okay, being, well, the 8th of April, okay? So this is New York session's defining range. Now, notice how there is a red line in dashes, and then there is a very fixed white line, which is just above the red one. The red dashes marks out the internal defining range. Okay, you guys can see the low and the high of this range is marked out in red. That is because that is the internal defining range. What is the internal defining range and what does it mark out? It marks out the body low and the body high of this defining range. Okay, now what does this line mark out? The fixed line, which has no dashes in it, the white one, marks out the wick high and the wick low of the defining range. So notice how this was the body low, it's marked out. This was the body high, it's marked out. So the internal defining range is the body low and the body high. And then this is the wick high, which is marked out. And this is the wick low, which is marked out. And it only marks out the highs and lows within the time frame of 9:30, as you guys can see, 9:30 all the way till 10:30. Okay, show you guys more examples. Right over here, this is London sessions defining range. This red line marks out the internal defining range. So the internal defining range marks out the body high and the body low. So this was the body high and this was the body low. This was the wick high, which is the DR, and this is the wick low, which is the low of the DR. Okay, so that is the difference between defining range and internal defining range. Now,
into the more important thing. It's how do we trade these concepts and what does it signify? What does the defining range tell us as traders? And I'll tell you exactly that. Now, this is the range that happened between the 3 to 4 a.m. window. This is the London sessions defining range. Okay. When price creates this range, whatever happens after is what is very important to us. Okay. Because once price creates this range, we simply wait for price to break out of this range. Whether it breaks to the upside or to the downside, that is what we wait for. So if we pay attention to this price action right here, if I just replay price to this point, okay? So let's just say that defining London sessions defining range has just formed. Now that this range has just formed and the body and the range has been formed, we then wait for price to close to the upside or close to the downside. And that is exactly what we're going to wait for. So we're going to wait for price to continue to do its thing, and we wait for it to do a body close above the DR. Okay, so once the body closes above the wick high of the range, this confirms to us something very important. Okay, and I'll tell you what it signifies to us right now. So now that price has broken bullish outside of our defining range, this tells us with 88% certainty, guys, listen to this statistic that I'm using. 88% certainty that this is the confirmed low for the London session, meaning price should not invalidate or take out this low. This is now the confirmed low for the London session, meaning from this point onwards, we should only expect price to continue over to the upside without breaching this low, meaning this has officially given us a bias which has 88% certainty. Because it has now closed bullish outside of the defining range with 88% certainty, we know that we should only be looking for buys. We shouldn't be looking for shorts because this is now the confirmed low. So now that this is the confirmed low, we know that we should only be looking for buys. Now, if we just continue to play price, what ends up happening? Price continues to rally over to the upside during the London session without taking out this low. Okay, so there are multiple points you could have looked to capitalize on. For example, when price closed bullish and it pulled back, the significance of these areas, the DR and the IDR, is very important as they can be a reference point for price to actually react from. So when we get that pullback and price is rejecting from the IDR level, and you can see that strong rejection candle, this is something that you can look to execute. Okay, so when price is actually rejecting from the internal defining range, this is something that you can look to execute from, but I'm not going to confuse you guys with that. We're going to stick to our concepts. We're going to use the supply and demand concepts because that is how I go about trading these concepts. But anyways, let's move on to the next DR. So if we continue to play price, okay, you can see price just continues to do its thing. How I would have taken this trade personally, it would have been something like this. Okay, so once price formed this confirmed high, I would have fibbed up the low and the high of this price range, and I would wait for price to pull deeper into a discount into an area that I'm more interested in buying in from. So as you guys can see, we've got this point of demand right over here. This would have been a reference point I would have looked to take in a position from. How would I have gone about trading this? Once price taps into this area of demand, I will monitor how price rejects. Something I usually do is wait for a 2-candle rejection from my level of demand before entering and executing into such a position. So you guys can see price is starting to range within our level of demand. So once I see candle rejection, but this bullish candle rejection, and in this second candle rejection, I would have market executed buys from the open of the third candle after the 2 consecutive bullish candles with stops at the wick low. As for TP, I would have personally targeted this high, and as you guys can see, it didn't actually end up coming into final TP. But let me tell you why that was the case, because if we look at this high over here, price has already taken out Asian highs liquidity. Okay, so this high should be a strong high, which is why price did not continue to breach that, as Asian low liquidity is still something that needs to be swept. Okay, but anyways, I'm just trying to make you guys understand the concept on the importance of the defining range. Okay, but anyways, let's go back and show you guys multiple examples. Okay, so you guys can see right over here what ended up happening. During the 9:30 to 10:30 window, price ended up closing bearish outside of this defining range. Now that price has closed bearish outside the defining range, what ended up happening? Price pulled back into the IDR. Okay, and you can see we start to see that rejection, and price just continued over to the downside to fill in the rest of this inefficiency. Okay, and I can continue to show multiple examples. You guys can see here, this is London sessions defining range. Price ended up closing bearish. Okay, so at this point, you guys have to remember, once price closes bearish outside of the defining range, that means this high, one second, that means the DR high should not be taken out. Price should not breach this level with 88% certainty. Okay, meaning this is officially the price range that we are working with. We don't expect price to come up into more premium levels. Price should respect this high onwards. So we simply wait for a pullback. Now that we see price pulling back, what do? We then use our normal concepts. We then fib up the price range from the wick high into the wick low. We look for our premium levels. Oh, sorry. We look for our premium levels. So this is 70.5, this is 79%. Let's go over to the 3-minute. We can see it's a very nice area of supply. Okay, this is our area of supply. As soon as price rejects from this point, that was a candle rejection. You can look to execute from this point as soon as the second candle opens. So the open of the second candle, which was here, that was the open, stop loss intact, and you could have looked to target, for example, the lows. Okay, let's say we just play price, continue, and price should continue with 88% certainty. It should continue over to the downside. Okay, and just like that, you guys can see it ended up coming into that TP as mentioned without breaching that high that was formed during the defining range. All right, so I can continue to show you guys multiple examples. This case right over here, the 9:30 to 10:30 window, price closes bullish and it just continues over to the upside and so on, so forth. Okay, this is the London sessions DR. Price ends up closing bearish. What does that mean? Price should continue to sell off during that session. Now, let's get into GU. Let's actually get into a trade that I took today. Okay, these were the longs that were taken today, and let me show you guys why. So if I just clear out my chart, let me show you guys why these longs were taken today. Let's replay price back into this point. Okay, very, very clean price action. Let's stick to the 5-minute time frame. So this was the New York's defining range during 9:30 and 10:30 window. What do we do first? We wait for price to break either bullish or bearish to give us our bias for the New York session. So if we continue to play price, what does it end up doing? Price ends up closing bullish outside of our defining range. Okay, now that price has closed bullish outside our defining range, we look for areas to buy from, right? Great. So what do I see personally? I see that price has created this form of liquidity just above this area of demand, which aligns with the midpoint of the defining range. By the way, guys, there are 3 significant things. The IDR, the DR, and the midline are 3 critical levels that price can reject and react from. Okay, so if you have an area of demand which also aligns with the midpoint, you have 2 confluences that increases that probability for this level to hold. Okay, so now that price has closed bullish, another rule that you guys should know is when trading the defining range, you are only allowed to risk 2 positions. You can only take 2 entries during each session to protect your account and your portfolio. So the first risk you could have taken is when price pulled back and it reacted on the first area of demand. You could have looked to market execute your buys from that mitigation off of the first level of demand that we see, which aligns with the IDR. So you can see price pulled back and start to reject from the IDR. You could have looked to execute buys from there, and you could have looked to target some previous inefficiencies, okay? But that's all irrelevant. For now, we'll just focus on execution. So first execution could have been here, and the second execution is at this level of demand, which aligns with the midpoint. So if price fails us at this area, we can look to enter another position from this point, okay? This is how we would trade during the defining range. You have two risks that you're allowed to do, and if you fail on one, you have one more, or if you break even on one, you still have two shots, okay? So let's just say, for example, you took the first one. We already know price hit stop loss. It did give you that rejection that you wanted. So if your TP was actually at the previous high, you would have actually made money on that, but in most cases, that won't be it. Price ended up pulling back, taking out those first buyers, and mitigating into the second area of demand. And this is where I personally executed from, because I understood that price may come back to induce this wick low and tap into the slightly more discounted level, which also aligns with the midpoint. So when price pulled back and tapped into this area, this is where I executed my buys with my take profit at the previous high. This is how I personally traded this setup. And if we just continue to play price, you can see it eventually came into our take profit. And there are multiple examples. Like during the London session today, you guys can see price ended up closing bearish. Okay, once it ended up closing bearish, it delivered that pullback. It pulled back into this level of supply. This level of supply aligns with the midpoint. Price ended up pulling back, reacting of this area of supply, which also is in line with this midpoint, and then it continued to sell off. But why did it not sell off to take out this low? Because this low already took out the Asian lows. Okay, so there is no more liquidity resting at these lows, as this was the sweep of that previous liquidity. But this could have been something you could have executed. Potential TP could have been at this demand or some inefficiencies here. Okay, and I can continue to show you guys multiple examples. New York session, price closed bullish, pulled back, reacted off this level of demand, moved over to the upside. Let me show you guys an example of a trade that I took and showed you guys in the Discord, where we made 3R on the NASDAQ. So this was one of the trades. If I just clear up my charts, you guys can see it a lot clearer and replay price back to this point. Okay, so this was the New York session's defining range. Price ended up closing bullish above our DR high. So what do we look for? We look for areas to buy from. What did I say, guys? You have two windows of opportunity to trade during each range. So there were only two levels I was looking at. I was looking at this level, this area of demand, which aligns with the IDR. And I was also looking at this level of demand, which is more in the premium. So I was willing to lose here and potentially win here, or I'm willing to lose on both because I have two shots to take per session. So what did I end up doing? Price ended up pulling back into that first area of demand. However, I did not market execute straight away. I waited for price to reject and close that candle. As soon as we got that candle closure, I ended up market executing from this point. Okay, and I was looking to take profit at some inefficiencies. I ended up taking profit at these lows here. Okay, sorry, that is not true. I ended up going to the hourly and I took profit at the body close. There we go. That's where I ended up taking profit. So if we go back to the 5 minute, as soon as we got that candle rejection from that level of demand, I market executed, and this is when I sent you guys this trade on the NASDAQ. So if we continue to play price, you guys can see price continued over in the upside because it closed bullish against the DR. What does that mean? It means this low is officially protected. Price should not breach this low. So now that we know that this is the confirmed low, we should only look for upsides. We shouldn't look at anything below this point. Okay, I can continue to show you guys multiple examples. Like I said, this was the EU trade that was taken today. Pretty sure if I can show you guys multiple examples. Okay, let me just get rid of this real quick. There we go. Okay, so this is an example right here. London session. What do we see? Okay, this was the London session. Price did not close bullish and neither did it close bearish. Guys, remember, if it closes bearish, it has to close bearish below the DR low. That confirms the trend. So it didn't close bearish during the DR low. So we have no bias up until this point over here, where price ended up closing bullish against the defining range. Price closed bullish. What did it end up doing? It continued over to the upside. Okay. And if I continue to show you guys multiple and multiple examples, you can see here what ended up happening at this point. Price created the range. Price did not break bullish or bearish yet up until this point right here. Price closed bearish outside of the DR range. Now that that happened, we look for areas to sell from. So now that we know that this is the price range that we were working with, we look for areas to potentially sell from. This level of supply would have been the first area, because if you simply take out your Fibonacci tool, it aligns with your premium levels. That 70.5 and the 79% aligns with this area of supply. So price pulls back into this supply, you look to execute your shorts. Very, very simple, guys. The rules are very basic. Once again, London sessions range was created. Price did not break bearish. It ended up closing bullish. Price ended up closing bullish. We have this area of demand right over here. What ended up happening? Once price closed bullish, it ended up pulling back, mitigating into this unmitigated area of demand, and it continued to move over to the upside. Guys, the opportunities on this are endless. It continues to happen day in and day out. Once again, you can look at this example here on gold. London sessions DR. Price ended up closing bullish above the DR. You have two windows of opportunity to trade this. Okay, you would have traded off the pullback into, let's just say, this area of demand, which aligns with the midline. This could have been something you could have looked to execute. And your second opportunity would have been the more premium level, which aligns with the IDR. Okay, so you would have got I mean, it all comes down to your TP setting, but if you ended up entering at this area over here and your TP was at previous highs, you would have made money on this trade. Okay, you've thrown a very nice 1 to 3. This would have been an opportunity you could have capitalized on. Or when price pulled back, you were hoping for a mitigation into this point. Unfortunately, it didn't deliver that mitigation. But in terms of your bias was still correct. Price closed bullish, it pulled back. It did not breach this low. It just gave that pullback and it continued over to the upside. Okay, once again, you guys can see here, this is the New York sessions defining range. Price closed bullish, it ended up pulling back, mitigating off of the area of demand. Let's remove this. The area of demand right over here, it pulled back into this point and continued over to the upside. It even mitigated exactly at the midline of the defining range. You guys can see the midline over here. If I just mark it out, it even pulled back exactly to the midline and continued to the upside. Okay, I can always show you guys multiple and multiple examples. Price over here during the New York session on the S&P, price closed bullish. And because it closed bullish, we only look for buys. So when we got that pullback and started to reject from the DR, you can look to execute. So the DR high is a point that price could be used as support and resistance, guys. So when you see that rejection from that point, you simply look to market execute off of that rejection, and TP settings completely up to you. You can look to target inefficiencies, areas of liquidity, so on and so forth. Okay. Once again, the opportunities are always endless. Look, notice this, guys, right? Price closes bullish during the New York session. It ends up pulling back. It even pulled back so deep, it wicked below the DR. However, it did not do a body closure below the DR. Once it does a body closure, then it completely invalidates the setup. But because price even though it breached the low, it did not close below the DR low. So this low is still intact. Once price was starting to reject and it formed that bullish candle, you could look to market execute and targeted the supply, for example. Okay. And I'm pretty sure I can continue to show you guys endless and endless opportunities. Okay. One thing that I must say though, when trading the when trading the DR session, just make sure you kind of stay away from red folders, because sometimes they don't play out during red folder news. Okay, but once again, this is an example on the S&P. This is the London sessions defining range. Price closed bullish. Okay, so first, and this is a trade that I took, by the way, but what you could have done, your first execution could have been, once price closed bullish, as soon as you got that pullback into the first level of demand, you could have looked to execute from that point. So when candle closed bullish outside the range, as soon as price gave that pullback into the first level of supply demand, which aligns with the IDR, you could have looked to market execute from this point, stop loss at the supply low, and you could look to target. I'm pretty sure we have all of these inefficiencies here. You could look to target multiple areas within this point. Okay, you could look to target this unmitigated level of supply, this inefficiency here, multiple areas you could have looked to target. And what ended up happening? Sorry, did I miss it? Where did it go? Where was that? Yep, right over here. Okay. So your first entry could have been from this point. Yeah, price was ranging, no problem. You still know this lows and tags. So if price fails, you'll just look for a re-entry. And that's exactly what I did. Once I saw this range, I wasn't too interested in entering yet. I waited for price to continue to take out this area, this high over here. Once it took out this high, it pulled back into this area of demand. This area of demand was also in line with the IDR. Price reacted from this point. Market executed with our take profit at this region over here. Okay. So the opportunity are always endless, guys. You will always see an opportunity to take a trade using this concept, okay? And it's very, very straightforward to understand. It is not difficult at all, okay? The opportunities will always present itself. So there will always be a point where you can look to execute to capitalize on the daily moves that happen during every single session. Okay, guys, I hope you guys understood the concept. It is not complicated. The only thing you guys need to know is the time frames that which the zones form in. And we mentioned the London session defining range forms during, if I just, I'm pretty sure I highlighted it right over here. There we go. Let me just zoom into that. There we go. Okay. So the main thing you guys need to know is that the London DR is formed during the 3 to 4 a.m. window during the New York time, and the New York sessions DR is formed during the 9:30 to 10:30 a.m. window during the New York time. Once those ranges are formed, you wait for price to break bullish or bearish outside of the range, and that will give you your bias for that session. Okay, so I hope you guys understand this concept. If you feel free to ask me any questions you guys have if you are not understanding anything with the concept in the Discord, and I'm more than happy to reply to you guys there. But that is it for this lesson, and I'll see you guys on the next.